Greetings. We welcome you to Insync with BDO India. Today's session will be led by Nilanjan Paul, partner, Risk and Quality, Audit and Assurance in MSKC and Associates LLP. Nilanjan will help us navigate the nuances arising from the recent accounting and regulatory roundups. Thank you, and over to Nilanjan.
Greetings, everyone, and thank you for having me one more time. I welcome you to Insync with BDO India, where we navigate the regulatory and accounting landscape, talk about emerging issues that are relevant for this particular quarter. Uh, I will begin with the accounting roundups, and in this section, what we will take you through is certain accounting developments which are not only relevant for this quarterly reporting, but even for few more important developments that are in progress. So beginning with the first development, which is effective from financial years beginning on or after 1st April 2026, is about the current and non-current classification of borrowing. So if you would recall, under Ind AS 1, we have a exception that if there is a breach of a material covenant of a long-term loan that has occurred on or before the reporting period, and because of this breach, if the loan becomes payable on demand, then Ind AS also provides that if the waiver for that breach is obtained from the lender before the financial statements are issued, then there are specific accounting treatment. So let's assume there is a loan that we have taken as of the end of the year, and there had been a breach in meeting the material covenants of that borrowing. But subsequent to the year end, the entity has obtained a waiver of that breach before the financial statements were authorized for issue. Now, this has been amended, as I said, effective 1st April 2026. But let's say for financial years ending before the effective date, financial year 2025 and 26, if I apply the requirement of Ind AS, then despite the fact that there is a breach, and since the waiver has been obtained before the financial statements are authorized for issue, the financial statements for 2025 and 26, such loan would still be classified as non-current. Now, what happens after 1st April 26? Now, after 1st April 26, even though the waiver has been obtained after the end of the year, the borrowing would have a current classification. So that's a very significant change, right? Uh, Especially the fact that we had this particular requirement under Ind AS 1, and this requirement has now been done away with effective 1st April 2026. And I'm sure we all will appreciate that any amendment to Ind AS is regarded as a change of accounting policy. And because of this reason, even the comparative information would get restated, right? So for entities which have borrowings, or where we have experienced a breach of a covenant in the current financial year, this might be a very important consideration where they are doing their financial reporting. Moving to the next amendment, the amendment has been agreed by the Institute of Chartered Accountants of India. They have also been sent to the NFRA, and the NFRA has also accorded their approval, and it is now awaiting the notification of the Ministry of Corporate Affairs. Now, this is an amendment related to electronic payments, and this is an amendment to Ind AS 109. It clarifies the point in time when a financial liability should be derecognized from the financial statements when it is settled through electronic modes. Now, if you would look at the screen, the derecognition criteria for the financial liability is on the settlement date, right? Now, the amendment proposes to clarify that for any financial liability settlement using a mode other than electronic payment should be derecognized on the settlement date. Now, for liabilities being settled using an electronic payment system, it gives a particular option, right? But those option is subject to certain safeguards and certain criterias. So if you would look at the timeline below, and we'll try to explain this by way of an example. If a payment of INR 5 lakhs is initiated at T0 and on T1, let's say the payment cannot be cancelled, right? For example, if you are doing an overseas payment, you have initiated an electronic payment, and because of this payment system, then the payment cannot be cancelled. Now, the Ind AS also specifies other criterias. There should not be no practical ability to cancel the payment. Uh, there is no practical ability to access this 5 lakhs of payment, and the settlement risk is insignificant. Now, if we meet these criteria, right, then only we would be derecognizing the financial liability at T1. Else, only when the payment is completed. So, very important consideration for entities which initiate transactions through electronic payments. We believe that these type of uh, accounting option would be critical for entities engaging in online payments using overseas payment facilities. But nevertheless, this gives a very important clarification for payments made through electronic payment system, which otherwise could have been understood to be at the settlement date. But with this proposed amendment, which is pending the notification of the Ministry of Corporate Affairs, with these safeguards of no practical ability to cancel the payment, no practical ability to access the amount to be used for payment, and the significant and the insignificance of the settlement risk, they are very important safeguards and clarification when we are uh, recognizing or derecognizing a financial liability settled through electronic payment mode. Now, in days 118, uh, the exposure draft has been issued by the Institute of Chartered Accountants of India. Um, Principally, this has also been approved by the NFRA. If you would look at the minutes of the meeting, which is available on its website, I think they do provide that direction. Now, in the standard, it is proposed that the Ind AS 118, which is a new accounting standard, would be effective for financial years beginning on or after 2027. Now, Ind AS 118 is expected to supersede the existing Ind AS 1. So we could all appreciate the veracity of this amendment. We expect the new standard to affect generally all the entities that is following Ind AS. So let's quickly look at what are the changes that we could expect. Uh, Substantially, there are many requirements which are there under the existing Ind AS 1 and Ind AS 8, they have either been incorporated in Ind AS 118 or they have carried forward substantially with very minor changes. So, for example, the uh, the assessment or the concept of going concern that has been carried forward. Now, the offsetting requirements, the norms relating to classification of assets and liabilities as current or non-current, that has been carried forward. Accounting policy, material accounting policy disclosure, that has been carried forward. Capital disclosures, they have been carried forward. So these important items, they have generally been carried forward from the existing Ind AS 1 and Ind AS 8. Now, what the new standards is proposing is to have a structured categorization in the statement of profit and loss, right? Now, there would be mandatory and additional totals and subtotals, right? That would be inserted in the profit and loss account on the face of the profit and loss account. There would be disclosures for management defined performance measures. Informally, these are known as KPIs, uh, and this would now feature in the financial statements. Again, there are aggregation, disaggregation, and other changes that are being proposed. But the main change is that the profit and loss account, or as we see presently, would be would have different categories, right? It would have some mandatory and additional subtotals. Now, because of this, there are also few other considerations, and obviously, the interplay between this particular proposal with the existing requirements is important. For example, in Schedule 3, we already have a kind of a standardized format. How Schedule 3 will interplay or interact with these proposed changes is something we need to watch out for. Similarly, we have the SEBI results, right? Will there be a change in the SEBI results that we also need to watch out for? Uh, Interestingly, there is also a proposal to introduce a functional classification of income and expenses, right? The concept of functional classification already existed under the International Accounting Standard, but they were not incorporated in India. But if you would look at the existing proposal, the idea is to propose a functional classification of income and expenses. There would be other considerations, for example, because of these changes uh, in the face or structure of the profit and loss account. If there is a requirement to look at covenants, then how it would interact with the covenant compliances would be an important consideration. Similarly, compliance with employee benefits provisions. For example, if the remuneration of the KMP is linked with a particular operating performance because of the reclassification of income statement, would my covenant compliances or the employee benefit provisions that would undergo a change? Again, an important consideration. So again, from Ind AS 118 perspective, it does not change the recognition or measurement of any particular accounting requirement or accounting standard. It only changes the way it would be presented in the income statement. So we need to watch out very carefully. There are developments which are underway, but uh, uh, we would need to see how this how the proposal ultimately takes shape for financial year beginning 1st April 27. Moving to regulatory roundups, the new Income Tax Act is effective 1st April 26. It has superseded the previous act of 1961. The idea is that to simplify the language of the existing Income Tax Act, and that is the reason it carry forwards substantially all of the provisions and requirements, but in a much more simplified form. So as a result, there is no major policy changes. Even the amendments that were incorporated in the last budget, they have been carried forward and included. There is no changes in the tax rate. And as I said, the intent of the new act is to remove redundant and repetitive provisions to have textual and structural simplification of the legislations. Now, since it's a big change from a regulatory standpoint, the ministry or the income tax department have been issuing various enabling measures. They have issued FAQs, they have issued various operational guidelines. So an important or a natural question which you might have is the implication of the new act on the tax audit for financial year 2025 and 26. Now, the FAQs have clarified that the tax audit and transfer pricing report for the 25-26 financial year, they would continue to be governed by the previous act, which is 1961, and the forms that were notified for such year. So as far as the tax audits and transfer pricing audits that we will undertake, which would be for 25-26, for them there is status quo. They would still be governed by the previous regulations. Labor code, again a significant change. As we would recall, the labor codes were made effective from 21st of November 2025. We had 4 labor codes. Those were made effective: Code on Wages, Code on Social Security, Industrial Relations Code, Occupational Safety, Health and Working Condition Code. Uh, there were also rules that have been notified. Many of the central government rules were notified on 8th of May 2026. And since this is also a state matter, the various state governments have either notified or they have issued draft rules. Now, an important consideration, the Provident Fund scheme. The code on Social Security very clearly mentions that there is a standstill clause, that the existing Provident Fund rules remains unchanged for 1 year from the date of its notification. So till 21st of November 2026, the Provident Funds would be governed by the existing requirements. But there is no change. But the ministry has also issued the new Provident Fund scheme, which is largely similar to the old scheme, but they have introduced or they have issued the new scheme which will be applicable under this particular code. Again, from enabling provisions is concerned, the ministry have been issuing various FAQs to ease the implementation. There is a handbook which the ministry has also issued to ease the compliance burden. But how does it stack up with accounting and financial reporting? Now, if you would see on the slide, we believe that these are the key judgment areas which we need to track and consider in our financial reporting perspective. And we would like to reiterate that these are the key judgment areas. There are consensus being built because this is an evolving legislation. We need to watch out for the developments as well. Now, as we would all know, there is a definition of wages. Earlier, generally for various social security schemes, the contribution of the employee or the employer's contribution was pegged generally on the basic plus DA. But now all the benefits under these 4 codes are pegged on the definition of wages. Now, since the definition has widened the base on which the social security contributions, the compliance are to be determined, then there is obviously uh, uh, a natural assessment of how much additional social security contribution that would be devolving on the employee. So again, for example, the PF on wages, when you apply the new scheme, will there be a change of contribution of the employer that we would need to watch out? The code also states or introduces new funds. For example, there is a reskilling fund. There is a fund or a cess for building and construction worker. So uh, uh, how will this be implemented? Uh, we would need to again watch out for that. Again, an interplay between minimum wages prescribed by the central and state. So many of these state governments are yet to frame the floor wages. Again, labor being a state subject, we need to watch out the interaction between the central rules with the state government floor wages. Classification between employees, workers, contractors, and fixed-term employee. Again, this would require judgment. Why is this classification necessary? Because the compliances would generally change or be incremental based on the category of employees. So for a fixed term employee, uh, as we know under the code on social security, the uh, the the gratuity benefits are preponed. They don't need to wait for 5 years. So again, this classification would be very critical. Applicability of overtime provisions. Again, these are applicable for for all the employees, workers, contractors, and fixed-term employees. Uh, as I said, since the definition of wages has undergone a change, how would the overtime benefits be paid would also be an important consideration for the employers. Now, employment contract versus service contract. The code has very clearly stated that the substance of the contract should prevail over the legal form, uh, and that would be an important consideration for entities that engage with with contractual kind of a professionals or contractual employees. Principal employers obligation, they have been expanded to cover wages, minimum bonus, etc. As you would recall, in the previous act, generally the principal employer's obligation were limited to payment of provident fund, but now the principal employer would still need to assess whether the wages, minimum bonus, and all other benefits under the act or on these codes have been discharged by the contracting agency. So again, important area that would require continuous monitoring. And as I would like to reiterate again, consensus is still being built on these judgmental areas. Well, so that's a wrap from our side, and that is all we had to cover. Thank you, and we'll wait for you to join in other sessions as well. Thank you so much.